as well. What are the kind of the longer-term takeaways, do you think?
Well, I think one is maybe this is going to be a wake-up call to Congress that they need to do something to arrest some of those deficits that you just mentioned. And, will we wind up in going forward having less fiscal stimulus than we have in the recent past? One of the reasons that we've cited for this massive inflationary impulse is the fact that you had both fiscal and monetary easing simultaneously in 2021 that you didn't have back in 2010, right, or 2011. 2011, when we had the debt ceiling, you had sequestration, fiscal retrenchment, even though you still had a lot of monetary easing. 2021, I think, it's not the only reason for sure, but it is one of the impulses that created the dynamics that we were able to have such high inflation that's been more persistent. So actually having slower fiscal stimulus, I'm not saying have none, but I'm saying, have deficits much lower than they are today, that could actually help our inflationary environment. And, now how you do that can be painful and politically very difficult, but maybe, maybe Fitch doing what they did could be a wake-up call to Congress to get something done.
Well, Mike's literally laughing on set. But, but if you look at the budget deficit, it actually has shrunk quite a bit since its lows during COVID. I understand it's still negative, but it has shrunk quite a bit. And I'm wondering, does it need to get to zero? Like, do we need that?
No, we don't need it. It really is irrelevant to the size of the U.S. economy. The problem is, I laugh because nothing's going to wake Congress up except a real emergency. And B, the problem is not in the stimulus spending that we did. The problem is going to be, because as you mentioned, the deficit's shrinking. As that goes away, the problem is going to be in the entitlement programs, Medicare and Social Security. And that's the third rail and the fourth rail of politics. And it's
you never touch it.
It's very hard to see, other than in a crisis, how they deal with it.
The genie's out of the bottle on that. Governments have got used to spending a lot of money, and that is now becoming increasingly embedded, be it Social Security. Just look at what is happening with the Inflation Reduction Act. Look at all the government spending that is happening as a result of the Biden programs that are being pushed through right now. That looks like it's going to become normal. Maybe it's a little extreme, but it's going to become normal. So what does that mean? Is that what Fitch is signaling here? Is that the long-term trajectory here? And that's what investors have got to adjust to. It has implications for the bond market, it has implications for equity markets, it has implications for real assets, infrastructure, commodities, etc. How do all of those different asset classes shake out in an environment where basically the rating agency is confirming that this is the new normal?
Well, I think you're confusing two sides of the coin here, Guy, in the sense that this is the normal we have now because the Biden administration was able to push this through. And if the spending that they are doing now is used as intended, it should bring down the U.S. fiscal issues because we will see more productivity and we'll be able to get more of a higher living standard and higher taxes and that sort of thing. The real problem, as I mentioned, is in entitlements, and because those don't change year to year. Those are on the path to destruction as the baby boomers retire, and that's something that needs to be addressed. And Fitch does talk about that, as S&P did, and nothing has really changed in 12 years. The fact that people know this is an issue but don't do anything about it. You'll probably end up with something like the Greenspan Commission back in the 1980s, where they sort of push hands off, let somebody else come up with a solution, and we'll all pretend we have to deal with it, and we don't have any say.
Yep. We'll leave it there. Guys, thanks very much. It's going to be interesting to see whether we get one more. Maybe that would be the wake-up call. All three. Mike McKee, Ira Jersey, great stuff. Fantastic coverage. The coverage coming out of Ira and the team, absolutely brilliant. Mike, thank you very much indeed. Coming up, Alex, what else have we got? We need to talk about some American Airlines headlines that have just dropped. Talking to Airbus and Boeing. I understand this is for a big order, and I understand it's for narrow bodies that they're talking about. There is still a huge shortage of aircraft out there. That's one of the reasons why airfares are as high as they are.
All right, well, coming up, we're going to go back to the question of the day. Did the downgrade change anything? And get the take from Henry McVeigh, CIO of KKR's balance sheet. That's coming up next. This is Bloomberg.
The Fitch rating downgrade came as a surprise.
A little bit surprising.
It's a bit of a head scratcher.
This comes at an economically sensitive time.
The likelihood of any impact is pretty small at this moment.
This probably doesn't really move the needle.
The bigger impact here is going to be politics and reputation.
This is the last thing that Yellen really needs.
So there is a governance problem.
In terms of, are we doing a trade on this? No.
Markets will just rush off.
The U.S. Treasury market is kind of the key to all the markets.
There really is no viable alternative.
So it's not going to be treated differently today than it was yesterday.
In the long run, very, very little impact.
Those were some of Bloomberg TV's guests reacting to Fitch's U.S. credit rating downgrade. So let's get the other perspective, and then a question of the day, does the downgrade change anything? With us now for an exclusive interview is Henry McVeigh, CIO of KKR's Balance Sheet. Henry, does it change anything?
I don't think this is like a Liz Truss moment in the UK where the market's speaking and it's going to raise rates. I think more structurally there are two things that are going on and you got to look globally. One is the Bank of Japan is changing their posture. That's happening at the same time that the U.S. is getting downgraded. And so that does create more structural upward pressure on rates. I think we've been talking about as a firm this regime change thesis, which is, inflation is going to come down, but it'll be higher and stickier this cycle. And I think that really affects how both individual and institutional investors should think about their asset allocation. I think we've talked about this in the past, Alex, doing more around infrastructure, more in private debt, and trying to find things that have collateral against them. And so that's really been a focus of ours at KKR. And I think the narrative over the past week, we've had two really big news events globally between the Bank of Japan and last night with Fitch, and I think we feel good about our positioning.
Henry, good morning. It's Guy.
Hey.
Okay, let's put those two things together. We've seen rates moving higher, US 10-year moving higher over the last few days. In fact, just as we speak, the US 10-year rises to 4.09. That's the highest level since November.
Yep.
Is that number, do you think, consistent with what we're seeing elsewhere in public markets? And I'm really referencing stocks here, but to a certain extent credit as well. Is that number consistent with how everything else is priced right now?
I think there are a couple things to keep in mind. Let's start first with fixed income, which is, remember, Japan owns more U.S. bonds than anybody. So some of the increase in rates may actually be related to the Bank of Japan, not to the downgraded. As I think both of you guys have been saying, is I don't think this event is going to lead to a huge spike in rates. I think on a relative basis, there's no question that right now, earning either 5+% in cash or what you can do in the bond market in high quality credit or in private credit, or we have something called asset-based finance, which is linked into housing and other type of collateral. Those are very attractive tactical positions. But most savers, and I think you were talking about this, one of the negative impacts of quantitative easing was that we starved savers by keeping rates artificially low. And so they're, over time, to kind of catch up, they're going to need to be further out on the risk curve. And that's where investments like stocks and private equity and other things that can adjust to inflation make sense. But on a tactical basis, most of our models would say that credit is more attractive than equities right here.
Just one more question, though, say on the impact of this and then the BOJ. Do we wind up seeing flows out of the U.S. into Japan? I mean, you guys are bullish on Japan. You think that they're exiting deflation. It's a big deal, like a huge change in the global economy. Do you see the money flowing?
So I think, I do think Japan is going to continue to perform. I mean, most areas of the world, inflation is a negative thing. It hurts buying power, and central banks have to react. Japan has been actually wanting this to happen for 20 or 30 years. So I think that the rates moving over there is actually reflective of stronger growth and maybe wages going up. Remember, this is financial theory, but stick with me. When you hold nominal interest rates below nominal GDP, it's still very stimulative. That was the whole point of quantitative easing, and so they're still doing that in spades, and so I don't think it will derail some of the success we've had in Japan, and the way there's a real move towards corporate governance that I think transcends some of the macro, and that's really where we focus in our private equity, our real estate businesses.
Henry, what do you think about China? You just got back from a trip. What do you said what you think about Japan. What about China?
Yeah, I think it's really interesting. My first time to both China and Japan was in 1995. I did the last trip I went to Japan and China. Japan, as we just talked about, is actually exiting deflation, which has been a long time coming. China, on the other hand, it actually feels the exact opposite, right? Their PPI is negative, their inflation is essentially near zero, and so it's almost like there's a deflationary bent. Now, what's interesting also from a rates perspective is China actually has really restrictive policy. Their real rates are among the highest in the world, so they have the capacity to ease quite a bit. I don't think they're going to do it the way they did in the 1990s or the 2000s, but there's more stimulus coming because they're in a restrictive policy mode. But I would say when you look at the numbers right now, savings is up, spending is down, and I think there'll be a longer kind of recovery from the zero COVID policy than certainly what we've seen in the West and even in Japan. I mean, the lines in Japan to get into customs with a yen at 142 are massive. And so people want to go there for vacation. They're starting to travel more around Asia, and they've certainly been a beneficiary of that, and the currency helps that story.
So, Henry, tie that in for me then when it comes to inflation. Because if China does stimulate, does that bring inflation back to other parts of the world?
Yeah, I think it's a great question, but I don't believe, I know that's a thesis out there. But
do you have a higher than expected inflation, a higher than consensus forecast for inflation in the U.S. for next year?
We do, but I think it's not driven by China exports. I think what's happening in China is there's a lot of excess housing and exports. China has about 15% of the global economy. Typically, that's when you peak. That's where the U.S. did. So two of their major drivers are slowing, and you've got a fair amount of debt. So all that stimulus is actually going into just deleveraging. So that's why you see huge money growth, but you actually don't see inflation going up that much. That's very different in the U.S., where I think the energy transition is inflationary, the labor shortage is inflationary, and then the third thing is I think a lot of reshoring, while it's probably the right thing to do over time, it's not as efficient as when we had global harmony around supply chain. So inflation's coming down, the market's reacting to that. Our call at KKR is it's going to stay kind of at a more elevated level and be more volatile than in the years that we've talked in the past, where it kind of came down secularly.
Henry, do you see a U.S. recession? Are you in the soft landing camp?
You know, I think when you look at our data, we've been arguing this year GDP would be around 1.8%, and I think the market's caught up to that a little bit. I would just caution when we look at 24, our models are suggesting slower growth. So the way we've been describing it internally and to clients is like less bust this year, but maybe less boom, because you pull forward probably some equity market returns, you pull forward a little growth because it's taken longer to slow down. As you get towards next year, a little bit of the fiscal stimulus slows down, and then ultimately some of that savings that's been spent in the market starts to be a negative drag, and ultimately we think unemployment's going to go up a little bit, but even anybody that's, that creates a little less spending.
So that doesn't sound then like we're entering a big distressed debt cycle. Like, I feel like distressed debt investors are like rolling up the sleeves. They're like ready to go, put lots of money to work. It doesn't sound like you think that.
That's not, one is in a higher nominal GDP environment, you don't get as much distress. Point number two is that's not our call. I mean, you can make really good returns right now saying kind of keep it simple. That's been our theme all year. I think when 22, our message was like walk, don't run. The market needs to resettle. We're trying to get money to work right now. We've been as active in our 47-year history in public to privates, which should tell you something about parts of the public market, maybe X the AI stocks. There's actually some good value there, and I just don't see that. So I think there's a decent environment for investing.
Okay, does deal flow start to pick up again? That's what I keep hearing. It's going to happen, but I don't know when, and I don't see it yet. It's interesting to hear you talk about the public to privates that you're doing at the moment. As a sidebar question to that, are lending standards, are private credit lending standards starting to ease, to become a little bit easier, i.e. are we seeing private credit becoming a little bit more covenant light? I'm just kind of wondering what's going on below the surface, Henry.
Yeah.
It's really hard to see from the outside what's happening.
So I'll give you the view from our engine room. One is that it's really shifted in terms of what you do in private equity. One is there are more buy downs of existing portfolio companies you have. Second is a lot of big conglomerates want to divest their subsidiaries. That's a very active area for for us in both the U.S. and in places like Japan. And third is they're more public to privates. What slowed down, Guy, is the private to privates. That's point one. Yep. On the credit side, I'm not as concerned about the lending standards. I mean, ultimately, the banks, I mean, we've been talking about banks and financials for a long time. I mean, they're in a little bit of a pinch here, right? SVB, had to pull back there. Second is a lot of them have, excess real estate exposure that they need to work through. And then the third is we're Basel III. All these things are talking, and other type of restrictions, they're talking about them holding more capital. That's actually not my view as somebody's been watching markets for a long time. Like, I don't think that. I think the banks are actually very well capitalized. To me, I think we're in a good spot. But that's creating alternatives to traditional lending, and that's where private credit comes in, and I think the terms are pretty attractive. I don't think it's the other thing I would just close with is, like, I don't think it's an either or. If I'm a corporate, I want to evaluate both solutions, and I may have some public, some private, and I'm trying to have certainty. This is a market of uncertainty, and so if you can provide somebody with visibility around the lending, that's what we try to do across our capital markets business. That's a very effective tool in a market where you've had the Bank of Japan changing, you've got debt downgrades, you got earnings this quarter going to be -9, right? So there's a lot of stuff out there. I think we've got to focus on, kind of what's the signal, and the signal is, to me right now, is that a lot of people were probably de-risked after Silicon Valley. There's been a catch-up, and the world's going to keep revolving, and we'll make it through, and you just need to change your asset allocation a little bit.
Henry, it's great to catch up. We always appreciate your time. We always appreciate you stopping by. Your wisdom is really useful into what is happening, as you say, in the engine room, as to what is happening actually below the surface. The stuff on Japan, the stuff on China as well. The China story, absolutely fascinating. I think Japan is where a lot of people are focusing. Henry McVeigh, CIO, KKR's balance sheet. Sir, thank you very much indeed. This is Bloomberg.
All right, just a quick check-in here on the markets. You look at the S&P now down by 0.9%. The Nasdaq 100 definitely underperforming, down 1.6%. But just look at the deterioration since we opened. A big part of that is going to be what we're seeing in the bond market. 10-year yields hitting the highest level since November. You have to wonder how much of this has anything to do with what we heard out of Fitch over the last 24 hours, or we're just sort of an excuse to sell, right? We were already playing the catch-up trade, and positions were kind of moving to one-sided. Euphoria was coming up a little bit, and now we're maybe reversing some of that. Well, coming up, we'll get to earnings with AMD topping second quarter estimates. That stock down. We'll get the latest. This is Bloomberg.
August is not going well for U.S. stocks generally. Big move in the bond market as well. Let's figure out what's going on. Abigail Doolittle tracking the action.
Yeah, Guy, we are looking at a pretty rough day here for U.S. stocks. The S&P 500 down almost 1%. Its worst day since May. And you can see the NASDAQ 100 and the Russell 2000 both underperforming to an even greater degree, even though for those indexes it's the worst day since late July. So it seems that this big rally that we've had, some of the froth coming out, but we also have the Bloomberg Dollar Index rising once again. If we take a look at a three-day chart of the Bloomberg Dollar Index, we are going to see a pretty solid gain here. Actually, right now, climbing to session highs up 1.2% as investors go back into this haven, really. It's kind of interesting because when you think about it around the downgrade, we had some similar action around the 2011 downgrade where down, up, but right now certainly a haven bid. This pushes risk assets lower. We've been talking about this in terms of the idea that there could be this inverse relationship. Today, though, let's look at a bearish divergence that's been developing that I just noticed somehow yesterday, not before yesterday. But you can see here's this rally on the S&P 500. Here's the RSI. The RSI has been putting in lower highs over the last couple of weeks. It's very subtle, but when you have a bearish divergence like this, it typically suggests that you are going to see some kind of a pullback. Today we have a gap down. It wouldn't be surprising to see the S&P 500 pull back down at least to its 50-day moving average or so, or possibly even the 200-day moving average if a lot of the froth comes out and folks are really fearful. Now, one thing that could maybe provoke that, earnings tomorrow for both Amazon and Apple. You can see Amazon and Apple both down sharply. For Apple, this is the worst day since May, down 1.2%. And Alex, if you can believe it, revenue growth for Apple. So Microsoft was one of the only big tech stocks down in July on the revenue growth being just high single digit. For Apple, it's expected to decline 2.5%. So it could be a problem.
You have to wonder, though, if you're selling into the tape, is that actually then, if you need a little bit or you just match, is that enough to get a little pop after earnings? Abigail, thanks a lot. Really appreciate it. Breaking news for you. The U.S. oil inventory report is out. This is why we care today. U.S. supply sees a record decline by volume last week. I mean, we're looking at a 17 million barrel draw in just a week in overall U.S. inventories as demand, particularly distillate demand, stays pretty chunky. Crude oil demand also good. You got implied demand pretty good for gasoline as well. That's a pretty solid draw. We're talking to Scott Sheffield of Pioneer and Rich Dealey, who's taking over as CEO in the next hour. This will be an interesting question to ask him about. Are you guys going to be pumping more because of this? Like, is demand really picking up?
It's a big week in terms of the oil market. Alex is donning a cowboy hat, going to Oklahoma tomorrow. We're going to have much more on the oil market over the next few days. Alex Steele will not be allowed to be on air over the next few days unless she is wearing a cowboy hat. Anyway, let's go a little bit further.
But go ahead.
It's true. Just watch. Let's go a little further west. What is it? 32 minutes past 7 on the West Coast. Ed Ludlow has got lots to talk about. It's the startup. We need to talk about what is happening in Silicon Valley because there's a whole bunch of stories. Yes, it's going to be Amazon. Yes, it's going to be Apple tomorrow. It's a big chunk, obviously, of the tech landscape. But we've got AMD today. And I'm a little confused by AMD, Ed Ludlow. Yeah. Why is the stock down?
I'm just looking at my screen, down 4.6% now.
Yeah.
They said that the market opportunity for their AI offering, which is an AI accelerator GPU or a GPU-CPU hybrid, is $150 billion by 2027.